Hi everyone, welcome to Kotak Securities Weekly Fundamental Podcast. I am Rini Mehta. Over the past week, Nifty lost 0.3% while Sensex lost 0.2%. Equities continued last week's recovery trend on increasing hopes of peaking inflation. Oil, gas and consumable fuels, capital goods and metals were top gainers, while banks, healthcare and FMCG lost the most. FPI outflows stood at $813 million over the past 5 trading sessions, while domestic institutions bought $1 billion over the same period. Now guys, the auto sales numbers will continue to drive stock-specific movements on Dalal Street as investors try to decode the future trend. Now, if you see, the question on everyone's mind as well as in your mind, I suppose, is this the end of the bear market or will it fall further? Well, that's something we need to wait and watch. In the meantime, the rupee fell to all-time low against the US dollar by the weekend to 79.11 as persistent foreign fund outflows weighed on investor sentiments. In another news to focus on, it was about that the center on 1st July raised taxes on the export of petrol, diesel and aviation turbine fuel, along with the announcement of an additional windfall tax on gains made by domestic refineries. In international news, the US GDP unexpectedly declined at a 1.4% annualized pace in the first quarter, marking an abrupt reversal for an economy coming off its best performance since 1984. The negative growth rate missed even the subdued Dow Jones estimate of 1% gain for the quarter. Looking at the FPI flows again, in June, FIIs were net sellers to the tune of rupees 58,112 crores, mainly on account of rising risk of inflation, elevated crude oil prices and interest rate hike by various central banks. We expect FPI flows to remain volatile in emerging markets. Going ahead, we believe inflation would be the key driver to monitor and decide the trend, coupled with a narrowing yield gap between bond and equities to make investors feel about market bottoming. Finally, let's look at some of the stocks to focus on. We have a sell target on MRPL, that is Mangalore Refinery and Petrochemicals Limited. Due to ongoing geopolitical issues, lower global petroleum product supply and lower inventory levels in Europe, global refining margins improved significantly in first quarter of FY23. Average Singapore complex refining margins increased to 21.6 dollars per barrel in first quarter as against $8 per barrel in fourth quarter. This will be positive for Indian refiners, we opine. However, we believe such an elevated gross refining margins, that is GRMs, are not sustainable in the medium to long run. Besides that, any meaningful fall in crude oil prices might result in inventory losses for refineries in general. During FY12 to 15, MRPL has made significant investments in expansion and modernization of its refinery. Despite refinery expansion and modernization, the company failed to meaningfully improve its financial performance. This makes us cautious on the company, and that is why we maintain sell rating on the stock with a revised target of 69 per share. We value MRPL on a PE multiple of 6 times for FY24 earnings, discount to its peers considering its size and limited retail distribution. Now guys, our pick of the week is SBI Life. We expect SBI Life to deliver 21% value of new business CAGR, followed by 18% annualized premium equivalent, that is APE CAGR, during FY22 to 25. Overall, individual APE, that is annualized premium equivalent, market share at 14.7% in 2022 is higher than 13.5% in 2021. APE growth will likely remain robust at 18% CAGR over FY22 to 24. Continued additions of new products to the product bouquet focus on increasing activation rates across SBI's branches and strong growth in business through new bancassurance partners will likely drive strong growth in APE. So we expect SBI Life to deliver operating return on embedded value of 19 to 20% over FY 23 to 25. And we expect SBI Life's margins to inch up further to 24.8% by FY 25 from 23% in 2022. So guys, you can consider buying the stock with appraisal value based fair value of rupees 1,525, and we maintain ad rating on the stock. So guys, that's all for today. See you again next week. Signing off.